The financial media is full of opinions and forecasts. Everyone has their own view on where the financial markets are heading and what investors ought to do next. The problem is no one can predict the future. Here at Sparrows Capital, we don't even try to. Our investment philosophy is based instead on long-term evidence backed by robust academic studies. We call this evidence-based investing. That research consistently shows us that picking stocks and shares or trying to time the market seldom adds value. So again, we just don't do it. So what are the academic conclusions that underpin evidence-based investing? Most importantly, research tells us that the primary driver of returns is risk. It's the investor's appetite for risk that should dictate portfolio construction, which in turn drives expected investment returns. But studies have shown there are several certain types of risk which over time have been better rewarded than others. Historically, small company stocks have outperformed large. Stocks generally have outperformed bonds, and bonds have outperformed cash. Within the equity markets, so-called value stocks have delivered higher returns in the long run than growth stocks, and low volatility stocks have outperformed high volatility stocks. The evidence also tells us that investment risk can be reduced through diversification. Stock picking and selective or tactical allocation rarely add value. It's important to remain invested throughout the ups and downs of the market cycle. And cost matters. We bring these conclusions together in a clear and simple investment philosophy. The first pillar of that philosophy is a strategic rule-based approach. One of the reasons why asset managers tend to underperform is poor behavior. In other words, they let their emotions and behavioral biases get the better of them and end up buying and selling at the wrong time. We are firmly fixed on our long-term goals, which should mean higher returns for investors. The second pillar of our philosophy is cost efficiency. Most asset managers don't like talking about cost. That's because they're expensive, and the compound effect of the fees and charges they apply can seriously affect long-term performance. We keep costs to a minimum by selecting low-cost index-based investments. The third pillar is diversification. Why is being diversified so important? Because it's the closest thing to a free lunch available to investors. Diversification is a no-brainer. It reduces the risk of a portfolio without sacrificing long-term expected return. We run global, highly diversified portfolios. The fourth pillar of our philosophy is liquidity. There have been several examples in recent years of investors not being able to access their money when they want to. All our holdings benefit from full daily liquidity to prevent that happening. The final pillar is transparency. Working out how much you pay to an asset manager can be very difficult. Nor is it always obvious how well your portfolio is performing or precisely what assets are in your portfolio. We provide clear, regular information to advisors so that they can make sure their clients are well informed. So the core element of our philosophy is that we don't try to beat the market. That requires subjective decision-making, which has been shown to subtract value in most instances. Instead, we take an objective approach. We invest for the long term in the whole market with the intention of delivering the market return minus a very small element of costs. And that, in a nutshell, is the philosophy behind the way we invest your money. We're not guided by opinions or forecasts, but by the objective lessons of more than a century of investment history. We apply those lessons systematically and unemotionally to deliver the best possible outcomes for investors. And we'll explain how we do it in our next video.